Welcome back to Iron Financial. Look, if you're trying to cut through market weakness and forge a significantly stronger portfolio, you are in the exact right place. Today, we're putting a $53 billion giant under the microscope. We're talking about Public Storage, ticker symbol PSA. They just dropped their Q1 2026 earnings, and sitting right there on the table is a massive industry-shaking $10.5 billion merger. So what does this all mean? Well, that's exactly what we're going to figure out. Are we looking at an absolute fortress with a rock-solid foundation, or are there hidden cracks in the armor? Now, I know the market skeptics out there are looking at these numbers, seeing a lot of hype, a bunch of corporate buzzwords, and some very serious integration risks. The $10 billion question is whether this stock is a true fortress for our capital or just a trap waiting to spring. Let's do the heavy lifting and test the actual structural integrity of this company. We're diving deep into Public Storage's Q1 2026 performance and that pending National Storage Affiliates merger. We're treating this explainer like a brutal, no-nonsense engineering inspection. We need to know exactly how much weight this balance sheet can hold, whether the current management transition is reinforcing the steel, and if their underlying growth is actually built to last. No fluff today, just the cold, hard numbers. Here is our blueprint for the analysis. First, the Q1 financial numbers. Second, the NAS merger. Third, the PS4.0 leadership transition. Fourth, the balance sheet. And finally, the verdict. Section 1. Q1 financial numbers. The solid foundation. Okay, this is where we separate the reality from the glossy press release. We need to know what the cash flow actually looks like down at the property level. Are they actually moving inventory, or are these storage units just sitting empty while costs inflate? Because the divergence in these growth metrics is incredibly stark. On the surface, the headline net income looks fantastic. We're looking at a GAAP earnings per share jumping from $2.04 in Q1 2025 to $2.71 in Q1 2026. That is a massive 32.8% surge. But hold on. As a seasoned trader, you should absolutely know that GAAP net income in real estate is incredibly noisy. It includes property sales and, most importantly, non-cash metrics like depreciation. A massive physical portfolio like Public Storage has a mountain of depreciation that artificially drags down GAAP earnings on paper. So what do? They add that back to find the actual cash they're generating. The metric that absolutely matters for a real estate investment trust, the real load-bearing metric, is core funds from operations, or core FFO. And when you look at that, core FFO only went from $4.12 to $4.22. That's a very, very modest 2.4% growth. Total self-storage revenues hit $1.22 billion, but with core FFO barely creeping up, it honestly feels like they're running on a treadmill. Is this genuine growth, or is the core business totally stagnating? That's a completely fair skeptical pushback, but we have to look under the hood at exactly where this revenue is coming from. The divide between their established properties and their new assets tells the real story here. In their same-store portfolio, these are the stabilized properties they've owned since at least January 2024, revenues were essentially completely flat at $1 billion. Net operating income, or NOI, grew by just 0.4%. And yeah, flat revenue on their core assets is a massive crack in the foundation. Realized annual rent per occupied square foot actually dipped by 0.3% to $22. But wait, look at the profitability of that core. The same-store gross margin before indirect costs is a staggering 77.1%. Let that sink in. They are operating with an incredibly high level of efficiency that most real estate sectors can literally only dream of. And more importantly, look over at the non-same-store column. This is their acquisition and development pool. Revenues here surged 24.8%, and NOI spiked an aggressive 27.5%. So they aren't just relying on legacy assets, they are actively bolting on new, high-growth engines to compensate for the stabilized mature properties in that same-store pool. Let's ground these financials in physical reality for a second. We aren't just trading lines on a chart here at Iron Financial. We are trading concrete, steel, and prime real estate. The same-store portfolio alone consists of 192.1 million net rentable square feet. Overall, they own and operate over 3,500 facilities across 40 states. It is undeniably massive, but as any skeptic will tell you, sheer scale alone does not guarantee a return on investment. True, but their capital allocation does. Over the past 5 years, they have successfully deployed over $12 billion in capital, and they have an ongoing development and expansion pipeline expected to add another 3.5 million square feet at a cost of roughly $618.4 million. They are continually pouring new concrete to expand the perimeter of this fortress. Okay, so they have this massive physical footprint, but inflation is a harsh reality for every operator right now. Labor costs, property taxes, basic maintenance. Are these compounding operational costs eating away at the profits of that fortress? Well, they absolutely would be if management was asleep at the wheel. But this brings us to their digital transformation, what they internally call the PS Next platform. Natalia Johnston, their Chief Digital and Transformation Officer, explicitly noted that their integrated digital platform actually mitigated inflationary pressures on their direct operations costs. This robust tech integration is the precise reason they expanded their same-store NOI margin by 0.4% year over year, despite all the economic headwinds. And crucially, they maintained a 91.5% weighted average occupancy rate, which is actually slightly up from 91.1% last year. The building is full, the operations are digitized, and the costs are heavily controlled. Section 2. Heavy lifting, the NSA merger. This brings us to the single biggest structural change in the self-storage sector right now. Public Storage is pending acquisition of National Storage Affiliates, or NSA. This is the move that is going to fundamentally redefine their portfolio for the next decade. $10.5 billion. That is the enterprise value of this transaction. It's an all-stock merger announced in mid-March, and it is a massive, aggressive play to consolidate a highly fragmented industry. Now, I see a $10.5 billion price tag, and my immediate reaction is concern. Are we overpaying for the M&A hype? Historically, mega mergers at the top of a cycle can be a total wealth destroyer for retail shareholders. They're acquiring NSA's bank debt, they're assuming mortgage debt, they're issuing new stock. This is an incredibly complex web to untangle. What is the actual tangible return on investment here? The return projections are heavily documented, and they are striking. They're bolting on over 1,000 properties, representing 69 million rentable square feet and 550,000 units across 37 states and Puerto Rico. Public Storage projects this will add 0.35 to 0.50 per share to their core FFO at stabilization, assuming, of course, they can actually stabilize it without severe operational hiccups. Right, which is exactly why the structuring of the deal is absolutely brilliant. Strategically, they aren't swallowing the entire $10.5 billion elephant onto their balance sheet on day one. They are forming an 80-20 joint venture with NSA's operating partnership unit holders. NSA holders keep 80% on inception, Public Storage holds 20%, but, and here's the kicker, Public Storage will exclusively manage the entire portfolio. This protects their balance sheet from an immediate shock while allowing them to extract massive value. They earn customary property management fees, asset management fees, and tenant reinsurance income. They also provide a $240 million mezzanine loan to initially capitalize the JV. If they hit their Q3 2026 closing target, this structure is an absolute masterclass in capital management. But let's pump the brakes, because this is where the Iron financial audience needs to pay close attention. The press release always paints a rosy picture, but the SEC's 8K filings tell the unvarnished truth. The 8K lays out severe, foundational structural risks. Integrating 1,000 properties isn't just flipping a digital switch. The SEC filings literally warn about the assumption of unknown or contingent liabilities. In real estate, a contingent liability could be anything from severe deferred roof maintenance to massive, incredibly expensive environmental remediation issues completely hidden in those 1,000 properties. They also explicitly warn about the failure to integrate operations and internal systems and the potential loss of customers and commercial relationships. Furthermore, they clearly state there could be performance shortfalls as a result of the diversion of management's attention. They are attempting to digest a $10.5 billion mammoth while transitioning their entire corporate leadership. That is a dangerous amount of heavy lifting happening all at once. If the PS Next digital platform fails to integrate these 69 million square feet smoothly, this $10.5 billion asset rapidly becomes a $10.5 billion liability. Section 3. Blueprint. PS4.0 Leadership Transition. If the company is taking on massive integration risks, we absolutely need to know who the architects are. Public Storage is calling this new era PS 4.0, marking the fourth generation of leadership since the company was founded back in 1972. The crucial point here is the C-suite changing of the guard right before the merger closes. On March 31st, Joe Russell stepped down as president and CEO after a highly successful 7-year run. On April 1st, Tom Boyle, the former chief financial and investment officer, took the reins as CEO. Concurrently, Shank Mitra succeeded Ron Hovner as the non-executive chairman of the board. Furthermore, they brought in Joe Fisher from UDR to act as the new CFO. Swapping out the foundational leadership team right before executing a $10.5 billion integration is arguably the biggest risk of all. PS 4.0, value creation engine, next-gen operating platforms. Honestly, it all sounds like classic corporate jargon designed to soothe Wall Street. Can Tom Boyle actually operate 4,500 physical properties, or is he strictly a spreadsheet guy? If you think it's just corporate hype, you have to look at the capital commitment. This is perhaps the most aggressively bullish signal in the entire earnings release. The new chairman, Shank Mitra, personally invested $25 million of his own money, and outgoing chairman Ron Havner invested $5 million into 10-year out-of-the-money options. We are talking about $30 million locked up in options with a $350 per share strike price and a strict 6-year lockout. Do you know what out of the money means in this context? It means they literally do not make a single dime unless the stock price goes on a massive upward run over the next decade. They cannot touch this money or realize a profit unless this company significantly outperforms. As a trader, when you see insiders putting their own structural integrity, their own personal wealth on the line with that kind of capital lockup, it absolutely answers the doubts. They clearly believe the PS4.0 execution will drive the stock price substantially higher. Okay, a $30 million options bet is deadly serious, for sure. But what about the massive culture shift? They are moving the entire corporate headquarters from Glendale, California, where they have been rooted basically forever, all the way out to Frisco, Texas. A corporate relocation during a $10.5 billion merger and integration seems incredibly disruptive. But actually, it's a calculated strategic realignment. The leadership explicitly stated they are building an own it culture. Relocating to North Dallas gives them direct access to a massive depth of tech and real estate talent in a highly business-friendly market. They are completely retooling the talent base to drive that digital-first PS Next platform and scale their data science capabilities. They even recently partnered with Welltower for AI-driven capital allocation. The Frisco move isn't a distraction. It is about building a high-performance engine absolutely required for the next decade of growth. Section 4. Structural Integrity Balance Sheet. A grand vision, a new CEO, and a shiny new headquarters in Texas mean absolutely nothing if the load-bearing financials buckle under the pressure. Because the absolute numbers look downright terrifying on paper. At the end of Q1 2026, Public Storage reported a towering $10.1 billion in total indebtedness. On the flip side, their total liquidity, meaning cash, undrawn credit, and retained cash flow, stands at just $1.9 billion. We are looking at a massive $10 billion debt load right as they are about to assume even more complexities with the NSA merger. How in the world is this not a glaring crack in the armor? Well, because you have to look at the leverage ratios relative to their cash generation, not just the raw debt figure in a vacuum. The absolute key number here is 2.9x. That is their debt to EBITDA ratio. It is incredibly conservative for a real estate investment trust of this massive size. Their net debt and preferred equity to EBITDA is just 4.1x. To translate this simply, their adjusted EBITDA to interest expense coverage is roughly 11x. Think about that. For every single dollar of interest they owe their lenders, the properties are generating $11 of pure cash. They are generating 11 times more cash than they actually need to service their interest payments. Furthermore, under their unsecured note covenants, their debt to total assets is sitting at about 18%. Which is miles below their 65% maximum limit. They have a pristine A2 rating from Moody's and an A from S&P. This debt isn't a vulnerability, it's a finely tuned, highly secure tool. And we see them actively managing that capital stack to reinforce the foundation. Just after the quarter ended, they successfully executed a public offering of $500 million in senior notes. They secured a fixed rate of 5.00%, maturing all the way out in December 2035. They immediately took those proceeds and cleared a $325 million balance on their revolving line of credit. So what did they do? They pushed their maturities out an entire decade while keeping their immediate liquidity completely open and available. Their weighted average interest rate across all debt is just 3.3%. This is Iron Financial 101, folks. Locking in long-term capital to fund aggressive short-term expansion without risking the core structure. Section 5. The verdict, opportunity, or trap. We have thoroughly inspected the foundation. We've read the blueprints, evaluated the debt, and weighed the integration risks. Now it is time to deliver the verdict. The bull case is incredibly strong. You have a massive company operating at a 77.1% gross margin on its core assets, which is practically unheard of in physical real estate. They are generating immense cash flow with an 11x interest coverage ratio, meaning the debt is rock solid. They have just upgraded their C-suite with a team so confident in the PS4.0 vision that they locked up $30 million of their own personal wealth in out-of-the-money options. And on top of all that, the NSA merger promises an accretive 0.35 to 0.50 jump in core FFO once stabilized. They are the undeniable heavyweight champion of the sector, continuously expanding their footprint. But the bear case is equally real and cannot be ignored. Same-store revenue growth has completely flatlined, meaning the core legacy engine is stalling out. To mask that organic stagnation, they are undertaking the heaviest lift possible, a highly complex $10.5 billion merger. The SEC 8K clearly warns of massive integration risks, unknown contingent liabilities, potential system failures, and management distraction. If the new PS 4.0 team fumbles the execution, or if the digital integration of 1,000 NSA properties hits a major snag, that projected 0.50 accretion will vanish into thin air, taking shareholder value down right along with it. The risks are very, very substantial. In our view here at Iron Financial, the pristine balance sheet, the 80-20 joint venture structure mitigating immediate risk, and the massive insider options buying push this firmly into opportunity territory for the long-term investor who can actually stomach the next 12 to 18 months of M&A noise. The foundation is solid, even if the remodeling process is going to be incredibly loud. But we really want to hear from you. Are you forging your portfolio with Public Storage, betting on the PS 4.0 team to execute the NSA merger flawlessly? Or are you avoiding the heavy lifting and staying on the sidelines until the structural dust settles? Let us know your exact thoughts in the comments below, hit that subscribe button to keep your portfolio forged in iron, and we will see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.